What's up, everybody? Welcome back to Thursday Thoughts on Investing. Today, we're going to talk about the only three market forces that you need to consider when it comes to investing, and we're going to distill and drill down right into the only three concepts that you really need to understand or consider when you're investing and growing your money in the long term. And when you understand this, when you see it from this perspective, what it means for you is that you actually know what's relevant and what is important when you come to preserving your purchasing power, i.e. growing it via the markets in the long run. There's only really three things that you need to consider. All will be revealed momentarily. So let's go ahead and jump straight into today's webinar. Thursday Thoughts on Investing, the only three market forces that you need to consider should you want to invest. Not financial advice, of course. Feel free to read through that in your own time. So here's the thing about investing. I always find that for one reason or another, people make it way too complicated, and you might find yourself looking like this guy, a little bit confused and not really understanding where is the first place to start. So the point of Dentistry Invest and the point of Thursday Thoughts on Money Mondays is to home right in on the fundamentals of investing and teach you what it is that you need to know in order to grow your money long term in the markets. And like I say, there's really only three things that you need to think about. And here's a really interesting framework that you can use to increase your understanding and another perspective through which to view the markets, as we spoke about earlier. So there's only three real forces. There's only really three things that we need to understand. And here they are. Capital appreciation / depreciation. So when we invest our money, will it go to the moon, inverted commas, or will it go to zero? That's one of the things that we have to consider. It's possible that when you invest your money, that might happen, particularly if you're buying a single isolated company or a single crypto or a bond from a single country. You know, every asset has this risk. However, you can mitigate this if you diversify across enough of those assets that the only thing that will ever sink your investment within that asset is if the whole asset goes to zero, which is extremely unlikely. So what do I mean by that? Let's put that into more understandable terms. So let's say I buy Amazon. Let's say I invest in Amazon, and what will happen, and what has happened historically is that Amazon's value is appreciated. So therefore, it would have made money. However, Amazon is just one company. Big companies can go bust spontaneously and out of the blue. You know, it's not totally unheard of. It can happen. To have all of my wealth concentrated in one company, even though historically that company has done particularly well, is a little bit too risky, given that my wealth is all concentrated in one thing. Now, and that goes for any company, just never mind how big it is, it's still a possibility. Now, let's consider this. How about if I was able to simultaneously invest in the top 1,000 companies from all across the world? Can you see how that the likelihood of all 1,000 of those companies going bust all at once is incredibly slim? Can you see also that given the world's economy grows at an average rate of 9% a year, I would say, from if we look at the historical data, if we look at the data via which the stock market appreciates, given that that is a rule that's held true for decades, close to centuries, isn't that a better means of storing our wealth versus keeping it in cash, which is guaranteed to go down in value? Of course, it totally depends on your goals and objectives. If you need the money very soon, then you might be best off keeping it as cash. But we're talking about the long run here. Can you see how if we're diversified across 1,000 companies all at once, that would be way less risky than keeping it in one single company, despite that how well that company may have done historically? Can you see how if we invest in that style, the only thing that can really sink our portfolio is if the whole world economies crash, all of them crash, all of the national economies of all the countries across the world crash all at once? At that point, we have bigger fish to fry. We're probably equating that to the simultaneous collapse of every society across the world and civilization as we know it at present, that would mean that we have much bigger things to worry about. So basically, we're hedging or we're betting on human progress and the economies of the world continuing to grow and humanity continuing to flourish and prosper, which it only ever has increased that as time has went on. We've only ever become more prosperous and living standards have become higher. That's basically what we're saying, okay, if we invest in the world's economy. And that's something that I'm pretty sure, and most people are pretty sure, is likely to continue for a long time. If the whole world's economy did, if all the economies of the world did crash all at once, that would also mean that the governments there would be nothing underpinning the governments. There'd be no capital coming into their tax, their tax kitty. So that would also mean that your currency is probably not worth anything either. Okay, because that at that point society is collapsed. Okay, so basically, if we're going to think about capital appreciation and depreciation, really, now that we know that those two events are linked, and that really if those things do depreciate or fail, we really have bigger problems to worry about at that stage. Can we now see how actually we can totally mitigate the risk that our capital would depreciate should we buy things that are suitably diversified? And that is one of the biggest revelations of investing right there. Buy the correct assets and there's no need to change them. Invest and forget. Invest in whatever asset it is that you've chosen, and then forget about it until it's close to retirement age, and then think about withdrawing it. Of course, this only applies if your time frame is greater than 10 years. Under that, things get a little different. However, it's a really interesting vantage point to view investing. Here's the trend of the world's economy. Here's the trend of the markets. It only ever goes up over long enough periods of time. And we're banking on that continuing when we buy the correct assets. Volatility. This is the second market force. The frequency and magnitude that an asset's value will shift around the mean, not to be confused with risk. Some people will say, if you invest in the stock market, it's high risk. Actually, as we know, risk would mean that we stand a chance of losing our capital in the long run. That would equate to capital depreciation if it went to zero. We know that we can entirely mitigate this if we buy things that only ever appreciate and we're patient enough. So risk for me in this sense is equated to the fact that we might lose our money, but we've already proven that that's never ever happened, and it's only likely to happen if the whole world's economy fails if we buy the right thing from the start. Therefore, when it's used in this sense, it doesn't actually accurately portray what we'd expect the term to conventionally mean. And actually, volatility is purely how much the value of the asset varies around the mean and goes up and down like this. So basically what it means is, how much is this asset going to emotionally test you whenever you've purchased it? If it goes up a lot in value, you're going to get really excited. Maybe you'll buy more. But actually, we should do the opposite. We should probably think about taking profit at that point. Depends on your style, of course. If it goes down, everybody gets an itchy finger and they begin to think about selling their assets. That's exactly what we don't want to do. We actually might want to think about buying more. However, it depends on the asset itself, of course. And I need to be very careful when I say things like that, because that's where a little bit of know-how comes in. But yeah, like I say, volatility and risk are not the same thing, and everybody confuses them with each other. Actually, the greatest risk of all is buying things which are not going to outpace inflation, therefore losing purchasing power with time. That's the greatest risk. So we're totally flipping risk on its head. Here's the mean of the S&P 500. You can see here, we would consider this something quite volatile because it goes up, it goes up, it goes up, it goes down, it goes down, it goes down. And you can see that overall, the overall trend is up, but it does vary a lot around this mean, this line of its average value, which I have drawn right straight through the middle of its valuation. And this allows us to gain perspective. Now, going through these is really tough. This is a 50% drop in your capital that you've invested in the market at that point. Very few people can watch their portfolios go down by 50%. But it's important to remember that in the long run, the correct things do appreciate. And I would happily go through this, I would happily watch my portfolio vary by a huge degree when I know it's the correct thing. And I know that when I purchase something like this, volatility is the price that I pay for gains in the long run. So volatility and risk are not the same thing. Inflation, this is the true assassin. This is the one that lulls us into thinking that everything is okay, but actually it's the main thing that's going to destroy our money with time. This is the one we really need to run away from. Not volatility, which everybody makes out to be risk, not capital appreciation, because if we buy the right thing, it's only ever going to go up in value. If we invest correctly, we can totally mitigate both of these things. And we can also totally mitigate inflation as well. Inflation is the one that creeps up on us because we all think that our pound that we have in our bank account, because it looks like it's not moving, it looks static, it gives us the illusion that it's something that's consistent and it's something that is holding its value over that period of time. Actually, its value is decreasing because of this effect called inflation. Now, why this happens, we won't get into today. We'll save that for another webinar. Storing more than necessary of your wealth in cash means this affects you significantly. Inflation is 10% at the minute. Inflation is 10% at the minute, which is absolutely crazy. And people are worried about investing. I'm more worried about having excess money and it's staying in my bank account, because that is seriously what is going to cause me to lose wealth with time. That is seriously what's going to allow me to lose purchasing power and effectively have my time that I've spent in work robbed back from me, which is what I really, really, really don't want. So flip it on its head. Cash is not safe. The markets, in a weird way, are actually safer than holding your wealth in cash, because they only ever appreciate with time, whereas cash only ever depreciates. And this is the one we're really trying to avoid. Here's inflation. Here's a historical chart of inflation. You can see it's been so high at some points in the past, 24%. That is absolutely bananas. Recently, we've had relatively low inflation, which has been awesome to live through, but it's kind of lulled us into this sense of complacency at the minute, where we expect this to continue. At the minute, inflation is 10%. Will it go up? Will it go down? No one really quite knows. So something to bear in mind. However, in the long term, the trend is clear. Inflation is always present, whether it's high or low. Fingers crossed it stays low, because then what that means is that when we invest, the greater the difference between the rate of inflation and the rate of returns in our investing is our net yield overall, is the net rate at which our purchasing power is appreciating, which is what we really want. So yeah, important to bear that in mind when you're investing. This is the real thing that's going to catch you out, and it happens when you have all this money in your bank account and it's not doing anything, and it's so easy to do that. Give it a home, whether it's in the markets or outside of the markets, whether it's in your ISA, in stocks and bonds and funds, or whether it's outside of that in a business or properties. At least give it somewhere so that it can increase in value rather than decrease in value. That's the whole idea. Summary: there's only really 3 market forces to consider. Each one of these can be mitigated with the correct style of investing. Volatility and risk are not at all the same thing, and just really be aware of that, because that is something that is perpetuated continuously in the financial services industry, and it makes no damn sense. Actually, if we look at the risky assets when it comes to long-term investing, they're actually the assets that appreciate. They have at the greatest rate, they have the highest return. So risk and highest return are 2 things that don't make sense in the same sentence, and that's effectively what people are saying when they call these things, when they call those assets, the ones that have only ever appreciated with time, high risk, because that makes no damn sense whatsoever. Really, they're high return. And that's how we should be looking at the world of investing. And even though it can be a little bit of a emotional white knuckle ride when you're investing in those things, it really is the quickest way and the only way you can ever beat inflation. Bonds will never beat inflation. Bonds rate of appreciation, and also their yield is like 2-3%, something like that, when you add them together, the total return, whereas the markets is more like 9 to 10%. Inflation is on average about 3%. You're not even beating inflation if you have bonds, particularly if it's high as well. So how can they be termed low risk? That makes no sense. If anything, they're at an increased risk of destroying your wealth over time. Just another way of looking at things. Thanks so much for attending, guys. I'll see you all next week at the next 30 Thoughts on Investing.